Hello and welcome to this market intelligence briefing workshop for the US Clean Tech and Climate Tech trade mission rapidly approaching in a couple of weeks. My name is Charlotte Connell. I would like to acknowledge the traditional owners of the land which we meet before we get started. And for me, that's the Gubbi Gubbi people. And I pay my respects to their elders past, present, and emerging. I am now going to hand you over to the capable hands of Yehuda, who your principal, is that right?
I'm a special counsel based
in
Melbourne. Yeah.
Fantastic. Who's going to take us through the legalities of and preparation needed to set up and raise capital in the US. We are heading over there soon, and it's something that they're getting lots of pep talks about, the style and language on how to pitch in America, but that's only one half of the capital raising part, as we all know. So I'll hand over to you, Yehuda, and
amazing. Thanks for the intro. I'm just going to share my screen over here, so hopefully we land up with the right screen. Can everyone see that? Awesome. So I've got my colleague Chris Spillman, who's our US partner. I might just kick over to Chris to do a brief intro on himself and Biztech before we get into the nitty-gritty of what we're presenting on today.
Yeah, thanks, Yehuda. I appreciate that. Yeah, I'm a U.S. attorney. I live in Virginia on the East Coast. So good evening to you all. I'm glad to be speaking to people who are living in the future relative to me. Biztech is the amalgamation of two practices, one based in Sydney and one based in the US, that are both several years old, but Biztech, the international incarnation, is about 1 year old now, actually just over 15 months old. We are a dozen lawyers based on, as of the 1st of November, 4 continents, plus one paralegal, or 2 paralegals, and a couple of support staff. And we think of ourselves as global business enablers. We really focus on helping our clients with multi-jurisdictional, cross-border deals, fundraising, financing, commercial deals, contracts, multiple jurisdiction, IP protection, all of that, from founders who are just a guy in their garage with some ideas and some prototypes, all the way up to ASX listed companies. And so I'm glad to be talking to you all about Australian tech companies coming to the US. That's somewhat our bread and butter, if you can call it that. There is a definite market that we are filling, and we tend to do a lot of this sort of business. So glad to go through these principles and concepts with you guys tonight, today, your time. And this is a screen that shows you a bunch of stuff that we do: M&A and business startup and fundraising transactions, et cetera, et cetera.
Awesome. Thanks, Chris. Well, with that in mind, what we're here to speak about today, sorry about that, is fundraising. And we're going to be looking at it from a legal perspective. We're going to be touching on some of the issues that come along with fundraising, what type of company structures you would be looking at, and some of the legal issues that you might encounter, both in Australia, but more focused on the US today. So we'll be looking briefly at company structure. When you're thinking about company structure, you're normally thinking about minimizing your risk, thinking long-term, both finance and project-wise. We have a view that Australian companies, the ones that are the most successful, are the ones that think global from day one. And that usually goes along with company structure. So from day one, you would be wanting to think about where you're planning to raise capital, where you're planning to set up your operations, where you're going to maximize your intellectual property and R&D benefits, and all of those type of considerations. And that will affect where your company setup is, where your head co, your holding co, the type of subsidiaries, and all of those issues. Then founders' ownership structure. Again, part of that is minimizing risk and maximizing flexibility. We work with a lot of venture capital funds and other investors, so we understand what they are looking for. So typically when you set up a company, you wouldn't necessarily be thinking about the same issues that a VC or a sophisticated investor are going to be thinking about when they come in at possibly your seed round. So we like to, get people thinking about those issues early. Intellectual property, where's the best place to both protect your intellectual property and also to get the most benefit out of it. Australia's got some really attractive R&D tax incentives. A lot of companies do their R&D in Australia to utilize those tax incentives. So again, thinking through those structures early. Cap table, just making sure that you understand who should be on the cap table, how much you should be setting aside for your employee share plan, and smaller issues, whether you're issuing shares or whether you're issuing through a SAFE or a convertible note. Regulatory issues, again, you're going to have different issues in different markets. Australia, you're governed under the Corporations Act. The US has a myriad of complex regulatory issues that Chris will touch on today. Your major contracts, again, that's going to be largely guided by your operations and your holding company. So your master services agreements, those will typically sit in your operating co. Your standard contracts, and then, any sort of longer term contracts. Funding types, we'll touch on, what a SAFE note is versus a convertible note versus a direct share issue. And then your governance, shareholders agreements, what you're looking to achieve out of those documents, balancing between control and investor oversight, trying to touch on those issues early, so you kind of find that balance and you minimize, if you're looking at a seed funding round, you want to try and have the shareholders agreement as close to what your investors are looking for, so you actually minimize the back and forth at that point in time. And then disclosures, once you're going through that fundraising round, what type of disclosures you would be looking at making. And that's getting into the real nitty-gritty of the due diligence process. Company structure and ownership. I might kick over to Chris for this one to give the US flavor on this.
Yeah, sure. Yeah, I feel like we're only 10 minutes in. We're almost through all the different topics that we might need. There was a lot on that last slide. A lot of it's on here as well. It's important to note, I think, that it is complex. There are a lot of considerations between the various jurisdictional requirements, local law in Delaware versus local law in California, corporate law concepts that you need to worry about, filings that you need to worry about, corporate formalities, board resolutions, shareholder resolutions. Keeping all of that in mind, you need to, I think, start with what are you trying to get done at a business level? What are the business goals? And once you kind of get that set, and especially as lawyers, once we get that set in our mind, then it's much easier for us to take all the complexity and narrow it down and help you figure out exactly what you need to do. Things like how many shares should we issue? Like, they become very easy once we kind of understand, how many shareholders are going to be right now, and when are you expecting to do your next fundraising, and what do you think it's going to be? What sort of fundraising do you think it's going to be? What is that all is going to flow from? What are your business goals? What's the runway you need? How much capital are you going to have over the next 6 months and 18 months? So those are the sorts of things that that we like to dig in with our clients on before we get into all this complexity about how you should and shouldn't structure your entities. Yehuda, is there anything else on that slide you wanted me to touch on specifically? I think most of it was on the prior slide as well. You went through it.
Yeah, I think that's fine. I think it might be useful, to talk through some of the holding company versus operating company and where we would usually suggest companies set up in a US context.
Yeah, and I'm not sure that we touched on it at the beginning, but there's a lot of detail in this, and there's probably going to be questions that pop into your mind. I'm fine with people interrupting, but if you want to hold them to the end, there's going to be time at the end as well. So just kind of keep them, and we'll be happy to address them. So this slide goes through, just kind of lays out in graphic form what a typical structure is that we see every day. So if you just start up your operating company and you're only worried about operating in one jurisdiction, and especially if you're going to be the only owner, or you and a friend, something like that, just having a single entity can probably meet most of your goals. But if you are going to go into multiple jurisdictions, if you are going to be raising third-party capital, if you are going to be borrowing a line that's secured by your assets, by the company's assets, you're going to find a lot of different situations where it makes sense to have a dual company structure. You have a holding company at the top that is essentially where all of the equity holders put in their money and have their equity shares coming out of. And you have an operating company underneath that has all the contracts, has all of the employees, makes all the tax filings, depending on which jurisdiction you are and what sort of entity it is, and really keeps the business in a separate box from the shareholders. There's a few reasons why that becomes very useful very early in a company's life. One of the simplest reasons is it gives you an option on exit to just leave that company as it is and sell all the shares to a new buyer. That's a very simple reason to do that. And this slide shows an IP assignment where the holding company gets the IP. If you don't have, we'll share these slides for sure. If you're in two jurisdictions, that actually might not be as easy as it's shown on here. And even if you're only in one jurisdiction, if you just have a Delaware company as the holding company and Delaware company as the operating company, you may not want to assign your IP up. There's kind of different reasons for why you would and wouldn't. But it's an option when you have two companies. You could also have a sister company next to the operating company that's your IP holder. But anyway, this is all sort of that complexity that we it's not very complex when you see it every day, which is what we do. But in your case, I think the most relevant aspect of the dual company setup is that you're probably going to be forming, you probably already have an Australian company. And if you don't already have a US company, you're probably forming a US company as a holding company and doing a transaction to flip up, as it's called, to the United States in order to raise money from certain investors in the United States who would prefer not to make investments in non-US entities, which we'll go through later.
And Chris, could you touch just briefly on, Delaware C Corp versus the other type of corporate entities that people might use?
Yeah, sure. So in the US, we have, generally speaking, a couple of different flavors of partnerships. And then we have what's more common to startup businesses like yours, which are your corporations and your limited liability companies. As an operating company, it really could be either. As a holding company that's going to be selling shares to especially venture capital investors or other professional asset managers. Typically, they're going to want to have you form a corporation and have that corporation be taxed normally, which is at the corporation itself is a taxpayer. There's an election that a corporation can make under certain conditions to be taxed as an subchapter S corporation. Assuming you're not doing that, which would kind of defeat the purpose of creating a corporation for investor purposes, you're going to be automatically a C corporation. There's nothing different between a corporation and a C corporation. C is just the subchapter of the tax code that a corporation is normally taxed under. So whether you're a Delaware corporation or a California corporation, New York corporation, or any other state's corporation, if you don't choose to be taxed as an S corp, which is very similar to partnership taxation here in the U.S., if you don't choose that, then you are going to be a C corp. So that takes the mystery out of what is a C corp. But the reason why venture capital investors and other institutional investors will typically require that a company that they're investing in be organized as a corporation and taxed as a corporation is because they don't want flow through. They don't want flow through taxable income. So they don't want to have to file. They either don't want to have to file as a U.S. taxpayer because they're a foreign taxpayer, or they don't. They can't. If they're a tax exempt entity, they actually cannot have flow through income from a for-profit business. So they would have to either set up their own what's called blocker corporation to handle the investment. But typically for these deals, it's not going to be large enough for them to justify that expense of maintaining their own company for the investment. So they'll say to the startup, we need you to be or become a corporation, taxed as a corporation in the US. And that's typically relatively simple, especially when you do it earlier in a company's life.
Chris, can I ask you, an S corporation, do you have to be a US citizen to be part of that S corporation?
No, you don't. If you own a piece of an S corporation, even if you're not a U.S. citizen, you will receive essentially flow through taxable income from that S corporation. So you will, assuming you get a flow through piece of that business, you will need to file U.S. tax returns, which means you'll need to get an ITIN in order to be able to do that. So you'll have to go through all of that. But if you just owned a piece of a C corporation, you would not be getting flow through income from that business. You would only be owning the shares, and you would only at some point in the future potentially be getting dividend income from that entity. So it's a different set of considerations. But just some of the details of S corps, has to have less than 100 shareholders, and none of the shareholders can be entities. So it's a little bit less relevant to most companies that are trying to get outside third-party investment.
So is an LLC a better holding company than for a startup than the S?
I would say typically we are advising people. It is situation dependent. We're typically advising people that based on their typical situation in the situations that we see mostly with tech companies they're starting they're developing a product, they're developing a business line. They're not expecting to be profitable in the very near term. So they are going to, if they're being taxed as a corporation, that doesn't actually matter because they're not making taxable income over the near term, the first few years of their life. So being taxed as a flow-through LLC doesn't really help you because you're getting passive losses that you can't do much with anyway. So leaving that as a corporation has a couple of effects. One, the corporation can build up those operating losses and then use them to offset future taxable income. Two, the investors in that company, if under certain conditions, so if you make an investment in a company, you hold that investment for at least 5 years, and there's a couple other ifs in there that are escaping my mind right now. But in those circumstances, you can I think it has to have less than $10 million in assets or $50 million in assets and $10 million in revenue, something like that. It basically has to be a smallish company and you have to hold the investment for 5 years, and it has to be a corporation, taxed as a corporation, then you can qualify on exit from that investment for what's called qualified small business stock treatment, which can give you up to each investor up to $10 million of tax-free capital gains. So there's a bonus there that, you know, it's 5 years in the future, so you don't always know that that's going to be useful for every investor. But if you don't structure for it, then you know it's not going to be useful.
Yeah, okay. Thank you.
Yeah.
Thanks, Chris. That was really interesting.
And Yehuda, I think I broke my promise about fast talking, so feel free to jump in and tell me to slow it down.
No, that's all right. So there's obviously a lot of consideration there. In Australia, it's somewhat simpler. There's, you know, a proprietary entity, a proprietary limited corporation that 99% of companies will set up with here. And when you're jumping across to the US, we always suggest, you know, getting good tax advice, because there are tax implications, not just in the US, but also how that money flows through to Australia. Particularly in a flip-up context, if you've got operations or a holding company in Australia and you're moving it over to the US, there are tax implications associated with that. So it's always a good idea to get the tax advisors working alongside the lawyers on those. Moving on to the next slide. So away from corporations, just basic protection of IP. That's really important. Doesn't matter what kind of company you are. It doesn't matter if you're a SaaS company or a deep tech or manufacturing. Your intellectual property is really, really important to your business. It's often going to be your biggest asset. So we always suggest that is a real focus of you know, company structuring from day one. It's one of the first things that investors will look at, is how a company has gone about protecting its intellectual property, making sure they've got an intellectual property strategy in place. How are you actually protecting it? How are you planning to use it? Making sure that everything's assigned. So if you've got contractors working for you, making sure that you've got good contractor agreements in place, or if you don't have good contractor agreements in place, making sure that you've got assignment deeds, so making clear that that intellectual property created by a contractor or by anyone engaging with the company is owned by the company. Employees, so in Australia, it's more straightforward. I believe that any intellectual property created by an employee is owned by the company. And so depending on where you're operating, you know, if you've got your operations or your employment operations set up in the US, you might have different considerations there. But again, just making sure that everything is clearly owned by the company. Cap table. So again, cap table, there's a lot of different, sorry, Chris, did you want to jump in?
No, go ahead.
Oh, sorry. Cap table, a lot of different ways to manage your cap table. When you're flipping up to the US, if you are setting up a holding company in the US, I might let Chris just add in his thoughts there on cap table management in Australia. It is fairly simple. If you've got a standard corporation here, you can obviously have individuals holding shares. You can have corporate shareholders who might be holding on, you know, as a trust. So there are various ways to do it. Cap table management, some people do it through a spreadsheet. There are a lot of cap table management softwares out there that are very good, very useful, but it is exceptionally useful to have all of that set up early, to have an understanding of how your safe notes, your convertible notes, you might have warrants if you're operating in the US, and how these all interplay with your planned fundraising, to just have an understanding of what converts at what valuation. If you've got a safe note, it will typically convert. If you've got a convertible note, that will also convert. Warrants will have different triggers included in them. Some of the warrants we've seen from a US perspective might have anti-dilution clauses in them. So up to a certain fundraising level, you might have certain anti-dilution provisions in there. So having a good cap table management early just helps you understand what those triggers are. It can also help you plan accordingly. So if you're planning for a fundraising round, it's not always, the case that you want to go and raise as much money as possible. There might be strategic raises that help you trigger certain instruments to convert at a particular point in time if there's a reason to do so. So again, just having those plans in place early. Chris, anything from your side on that?
I just wanted to add a few things. Yeah, so I think what you want to think about when you're managing your cap table, you could do it in Excel. You could do it with a spreadsheet, especially early on. Pre-seed, I see a lot of founders who just say, look, there's two of us. So it's easy to just say, here's he has 50% and I have 50%. It's easy. But once you get to, we've got some convertibles, we maybe did a seed round already. We are now in, we're now taking it from an Australian company to a US company, and we're doing some conversions and some share exchanges. And you're going to talk to US investors, or really any investors, but especially to venture capital investors. They're going to want to see that you have all that stuff in order, that it's not been manually created. There's not, the likelihood of it being, having an error buried somewhere in a formula that they, can't immediately suss out. So something like someone in the chat recommended Cake Equity. I have seen that. In fact, I think there was a slide here before I replaced it with this one today from Cake Equity. I think I've seen more of our Australian clients use Cake Equity than our US clients. This is actually a real cap table from one of our US clients who had originally started as an Australian client, but this is out of Carta. And so Carta is another platform similar to Cake. I can't speak specifically to Cake, but I can speak to Carta. I have used it. I have managed cap tables for our clients in Carta. Using a tool like this is important, I think, because once you get to even just having one convertible that has, a discount, a cap, all these different features to it, and then trying to figure out how you're going to model waterfalls and the future events. You really have to have it in this, because these platforms are built for a purpose. They have rules built in that will help you just manage those financial aspects, but they will also have built into them the guardrails that you need for tax and securities compliance purposes, which is really important. And so when you're using a platform like this, the investor will look at that and say, okay, they're more likely to have their stuff together than the guys who just came to me and gave me an Excel that they had to send me a second version because the first one had an issue with it, if that makes sense.
Absolutely. And you mentioned in the securities law compliance, so maybe you can just jump in with some of the regulatory issues that might.
Yeah, I think next couple of slides might be mine. So regulatory issues to consider. I have another slide later about securities law specifically, but in the US, there's a lot of different industries that have specific regulatory regimes, and we have quite a patchwork of both federal and state regulatory regimes. Some of the most regulated industries: finance and credit, obviously, transportation, defense tech, pharma, energy, consumer goods, food, alcohol, both manufacture and sale and distribution, and even entertainment, at least if you're in California, can be pretty heavily regulated industries. And you want to make sure that you've got your ducks in a row as far. Oh, cannabis is another hot one right now. You got your ducks in a row as far as the various the patchwork of potential regulations that might apply to both the operation of your business internally, and also the sales of your securities, and the interactions with your customers. So there could be, this talks about special regimes and regulatory benefits. Sometimes there's like pilot programs you can opt into, or there's a registration that you need to make in order to be able to get access to some of the benefits that are available to participants in your industry. A lot of times regulation is set up to be, it's set up with a great purpose of making sure that people are protected. The consumers, especially of whatever is that industry, are protected, but they function in practice also as a barrier to entry. So one of the worst things you can do, obviously, is to get in, not know exactly what you're doing, or not have everything tied up, and then kind of be kicked out before you even get started. Some of our clients who have come up against regulatory issues, especially fintechs, both at the federal and state level. We have had consumer-oriented fintechs who come up against very uncertain regulatory landscape, because the financial regulations and the consumer finance regulations, especially, were written and built in an analog world, and they don't necessarily they're not necessarily evident how they should apply to some of the new products and the new constructs of that fintechs bring to market. Data privacy is obviously going to be big everywhere. It is still less of an issue here in the US than it is in Europe, but with California leading the way, as they usually do in regulatory issues, it has become, in the last couple of years, a very hot button issue, making sure that you know where your personal data is, your personal information is, where it's coming from, how you got it, what are the consents that you got, what are the uses you're putting to it, who are you sharing it with, who are you selling it to, all of that stuff. And similar to how the European regulations kind of guide how the rest of the world deals with data privacy in a lot of ways, California guides or influences a lot of the ways that data privacy is managed across the US. So that's the jurisdiction that we tend to pay the most attention to.
And Chris, how does California match up generally to the GDPR type legislation?
There are differences. It's somewhat GDPR light. Some of the constructs are very similar. Confusingly, the terminology is not. The basic elements of California law is, if you are gathering consumer info for your own business, for your business with the consumer, you're probably okay. If you're using that info that you have and giving it to a third party, whether you're literally selling it or you're giving it to them in some other sort of commercial context, then you have a new set of rules that you need to follow in terms of what you need in your privacy policy, and what options you need to give to consumers to opt out of that data arrangement, which means now you have to track where all the data comes from, which data is associated with California consumers, where it's gone, in your system and out of your system, all of that stuff. So that's pretty similar to Europe, but the constructs around consent and legitimate use, and what you can and can do with people's personal data, there are still significant differences, and California is behind GDPR in terms of the restrictions that it puts on businesses, which I guess we can say thankfully, but also potentially temporarily.
And I think also, it's quite a topical discussion because there's been a major data breach in Australia the last couple of weeks. Optus, one of the big telecoms providers here, there was a data breach that resulted in about 10 million people's personal data being leaked. And so that's kind of brought to the front of a lot of people's minds, just the relevance of not just complying with the law, but also having appropriate data protections in place. And I think that applies globally. That's not, Australia or the US. That's just a global issue. And obviously, tech companies are very they're very open to attack because they operate in the cloud, or they're operating online, and they're typically relying on data for a large part of their business. So I think, it goes beyond just California or the GDPR. I think it's becoming more and more relevant to have, appropriate data protection strategies in place, not just reputationally. Optus is now facing, major financial penalties and possibly litigation. So I think when you're looking to raise capital, that's going to be something that investors everywhere will be focusing their minds on.
Definitely.
Yeah, could I ask a question? Where you or assign a patent to, let's say, an S corporation, how would that affect the local government R&D benefit here in Australia if you're developing in Australia?
Good question. So usually my understanding of the tax regime is as long as the activities are taking place in Australia, it doesn't necessarily matter where the IP ownership is sitting. So you have a lot of US companies actually coming to Australia, particularly in the biotech space, which is not necessarily relevant to what you guys do, but that is where a lot of R&D takes place. And so the ownership will actually sit at the US parent level, and they're still able to access those R&D incentives. But yeah, it's a good
true.
question.
I was gonna add it could be consequential whether your patent is just applied for at the US level or assigned to after award, assigned to the US level, as to whether there's an export there. But again, we would defer to your tax advisors on those questions. But those are the sorts of things that we want to be aware of. What are the goals of the business, and how is it best to structure it from the beginning? Once you get to where you are, also, is it worthwhile to try to relocate the intellectual property, or is it something that can be left in place and then just use an intercompany license in order to transfer that benefit?
Okay.
Just mindful, we've promised 10 minutes at the end for questions and discussions. We might just jump along, Chris.
Yeah, that's fine. Why don't you jump to, where are you? So securities laws. I mean, just briefly, securities laws in the US, they apply to anything that you think of as a security. And really the definition of security is just a laundry list of things like stocks and bonds and safes and convertible notes and warrants and options and everything kind of you think of it that might be a security, and even potentially cryptocurrencies, depending on how they're structured, could be securities today as well. And securities, offerings of securities in the US are regulated at the federal level by the Securities Act of 1933, and also at the state level. So and there can be preemption by the federal regime, but it's not always the case that there's preemption by the federal regime. But in general, the rule is you can't offer a security to someone else in either a primary sale as an issuer or in a secondary sale, unless that offering is registered, the security is registered with the SEC, or there is an exemption available in the law that applies to that transaction, that offering. So some of the available exemptions are, there's private placement exemptions that might be available depending on the size of the offering or who the investors are going to be, whether they're accredited investors or not, how many non-accredited investors you need to include in your offering. When was the last offering you did? There's usually an aggregation of a 12-month period where any offering in a 12-month period is considered part of the same offering for the purposes of measurement for these exemptions. There's regulation crowdfunding, where you can go onto these platforms like WeFunder and sell up to $5 million. But you have to do it via those portals that are registered with the SEC, and you have to make certain disclosures and certain filings with the SEC in order to do that. Then you have, the offerings that happen under your employee benefit plans, your employee share schemes, as you call them in Australia. We have an exemption from registration for those. It has certain rules that you have to fit in order to qualify for that. All of that stuff is very complicated when you're dealing with the typical sort of safe and seed rounds that venture capital investors are involved in. They're going to fit into one of these. So in general, they're not something that's going to be a hindrance from doing that, but they are something to keep in mind, because you don't want to blow them in with respect to $1 of your offering, because that will ruin the exemption for your entire offering.
And so if you're not subject to an exemption, are you required? In Australia, you've got the disclosure regime. So typically, in early stage companies, they would only be offering shares to sophisticated investors. There's a specific asset test in Australia for what a sophisticated investor is. If you're offering shares in Australia outside of that, then you have to make quite detailed disclosures. How does that operate in the US?
We have a similar concept. That's the accredited investor concept. Here on the slide, you see 506B/C. That's the exemption where you can have an unlimited amount of money from an unlimited number of accredited investors, and you can include some non-accredited investors, some just friends and family, or special employees, or whatever that you want to include in the round. If you have any non-accredited investors, you cannot have general solicitation or advertising, however. So it can only be people that and that includes the accredited investors. There cannot be any going out and putting it on a discussion board. There cannot be any, putting an ad in a conference flyer or anything like that with respect to that offering, if you have any non-accredited investors in that. So there's certain very similar aspects to U.S. securities laws that, as there are to Australian securities laws, but just because they're similar, they're not the same. There's lots of ways to raise money from, other than sophisticated investors. Regulation crowdfunding being a key one. I mean, that there is no requirement that anyone who participates in a crowdfunding offering have any sort of sophistication. Anybody can go onto those portals and make an investment in any company that's on those portals. And there is a level of disclosure that's involved in that. I don't know how it compares with the disclosures you were talking about. It's not very detailed, I can tell you. I've gone through it before. It is not nearly as detailed as an S1 to become a public company, essentially.
Yeah, I mean, in Australia, we've also got the crowdfunding. We work with a company called Virtual, which is one of the big crowdfunding platforms over here. I mean, in Australia, it kind of becomes like a mini IPO if you're going through a crowdfunding round. So there are quite detailed disclosures required, but not quite as detailed as an IPO. But that's definitely useful to keep in mind.
Yeah, it's not nearly as detailed here. It's basically 2 years worth of reviewed financials and a management presentation and risk factors. And that's essentially the level of disclosure that you need for a regulation crowdfunding offering here.
Awesome. So I might just touch on this slide, just noting the time. Capital raising, your legal considerations for funding rounds. So obviously these will become relevant when you're going through the funding round, but again, it's one of those things that we suggest, thinking about early. Investment valuation. So we didn't really get to touch on safes or convertible notes, but those are the instruments some of you may be familiar with. They don't require valuation to take on the investment. So the way those typically work is that you would offer a discount to a future priced round. Now, typically when we talk about capital raising in an equity round, what that requires then is it requires the company to actually put a valuation on itself and on the shares that it's selling, whereas a safe and a convertible note and a warrant do not require a company valuation at that point in time. So thinking about the level of investment that you are looking to take on and the valuation, obviously, US dollars, I mean, it's the same concept, but, just thinking and through in that context. Board control, what do you have currently? What are you looking for? So are you happy to give up a board seat or 2 or 3? Are you going to have one investor? I believe, similar considerations in the US, most investors will want some level of control, which may include a board seat and possibly an observer seat. Chris, maybe you can share your insights there.
Yeah, I mean, those key terms will typically come across in your lead investor's term sheet. They'll say, look, we're going to make an investment of $1 million. And this is usually for a priced round, and not usually for safes, but we're going to make an investment of $1 million at a $5 million valuation, for example. And we are going to want all of the typical minority holder protections. And that's going to include things like a liquidation preference, a board seat, some supermajority or unanimous voting matters, anti-dilution rights, all of these different things. And that's the laundry list. That's essentially, there's another slide later about shareholders agreements. That's where all of that goes. It's basically everyone's going to agree that no one's going to do anything unless that key investor says, yes, it's okay to do it.
And are there any specific terms at the moment that you're seeing in the US with the changing investment landscape? Are you seeing any sort of, not predatory, but any more kind of aggressive terms coming out of the VCs and investors?
We represent a VC fund that is making investments in particular with respect to companies that are operating in Africa. They have recently shown us a few deals where this is essentially the companies in dire straits because they've gotten to the end of their cash runway and they need more, and it's not as free flowing as it was last time they went to the market. So yeah, they're in a position where both the company is more desperate and the VC fund also has to defend its investment decisions to its investors. And so yeah, we're seeing down rounds in terms of valuation. We're seeing much more investor protections, liquidity protection, priority, convertible notes with warrants, as opposed to just taking preferred stock even. So yeah, we're seeing a lot of that. I don't know if you could call it predatory. I mean, the company needs the cash and there's not that many places to get it. So I think there was a question, but I didn't see it in time.
Well, maybe with the time left, maybe we'll jump into the questions. I might put the slides off.
Yeah.
Hey, I'll just repeat my question from the chat if I can.
Yeah.
Yeah, you mentioned the last thing on the slide there was about anti-dilution rights. Never understood why you'd offer them. Is it just one of those things that the VC may kind of try to insist on?
Yeah, so anti-dilution rights are typically, I mean, it's not, you can't do any any other issuances. You can't do most issuances that would be dilutive to that investor without that investor saying, yes, this is good for the company, and I'm agreeing to be diluted. So it'll typically have exceptions for things like you can issue equity to convert your existing safes, or you can issue equity to, under the employee share scheme. But you can't go and just bring in another C-level and give them 5% of the company without getting value for it. Essentially, that's what they're worried about. They're worried about equity coming out of the company without value going in.
Okay, so I'd seen clauses along the lines of you must top us up, issue new shares at no cost. Is that? Yeah,
typically
normal?
that, I mean, it can either say you can't do it, or if you do it, here's what happens. A ratchet, an automatic ratchet. So if the company goes out and it gives, and the ratchet is typically more relevant in down rounds. So investor A comes in at $10 a share. The company now needs to raise at $8 a share. Investor A is going to seek anti-dilution protection that will essentially convert the investment that they made at $10 a share into an investment at $8 a share, so that they make sure that they're not in at a disadvantageous price. That is a hampering and a hindrance to the company, obviously, because now you essentially have only one way that your share price can go, and if it doesn't go that way, you're in a bad situation. But at the same time, a lot of people will give it.
Yeah, thanks.
Yeah. And I don't know if it's optimism bias, maybe. Everything's always going to turn out great. It's turned out great so far.
Well, it occurred to me if some clause I saw once read, like the next round, an up round, your shares are now twice as valuable as the previous round. And if the previous shareholder had anti-dilution rights, they would just be issued a bunch more shares at this.
So
it's like, wow,
it should have been written.
Really valuable,
obviously,
right?
Obviously, I don't know what the details of that were, but it should have been written theoretically. The typical way would have said that is an exception to the anti-dilution rights because it's coming in at a valuation higher than what I came in at as investor A, and the company's getting value for that investment. It's not it's not just a grant of equity for no value. So that should have been an exception. But if it wasn't, then somebody
but that's what it's about. It's about making sure the terms into which those things apply are in your interest. Yeah. Okay.
Yeah. Exactly.
And Chris, if you could give us a 2-minute lesson, the one document that I think a lot of these companies might see from US investors that they haven't seen from Australian investors are warrants.
Okay. So warrants are less common in like a venture capital investment, but they tend to come along with a venture debt investment. So if you go and you do you want to borrow a line of credit from a venture bank, let's say. We did one for a client in recent history that came out of the CIBC, one of the Canadian banks. So, they may say, all right, we're going to give you a line of credit. Maybe it's a term loan plus a revolver, and here are the terms that we can offer you. And they're probably better terms in sense of interest rates and covenants than you would otherwise be able to get as a startup company from a bank, if you could even get a line from a bank as a startup company. But in exchange for that, sort of taking on that extra risk, they're going to say, well, we know we're helping you out. We want warrants. We want warrant coverage, essentially was what they'll say, on our line. So if you take out $5 million and we have 5% warrant coverage, we're going to get $250,000 worth of warrants, which is just an option to buy stock from the company, that are going to they're basically free. You basically just give them to the bank, and then the bank has a piece of your upside going forward in exchange for making the capital available to you on a debt basis.
I've also seen them from strategic investors, right? You're doing a project with them, and the terms of the warrant, the trigger points are the success of the project in some sense.
Or I've seen them just with key key customers. A key customer that is going to give you that demonstration of your product market fit, or the demonstration that you've got, traction, as venture capital investors are always saying. I need this deal. I'm willing to give up a piece of my company in order to get this deal. And the way to do that is with warrants, because they don't have to pay for them today. It's just a right to basically participate in the future appreciation of the equity of the business. So yes, strategic reasons, always, including, taking out a venture debt line is definitely a strategic decision for the company.
It's quite an interesting thing to put into a sales contract, in a sense, because you've given the customer a strong reason to for that project to be a success, and a lot of projects are dependent on the customer to be a success. Yeah, not just you.
Very true. Very true. There's a lot of appeal to it. Not only am I the startup getting the benefit of associating with this more established brand, or whatever is that strategic reason that we're entering into this agreement in the first place, but now I'm aligning the interest of this very important person in my industry with my interests. So if hopefully they're going to be looking out for me and making introductions to others to help my business succeed even more. They can be powerful incentives.
Awesome. Thanks, Chris. Well, I see we are running up to the end, Charlotte. I don't want to keep anyone beyond time.
Thank you. This is also their second workshop today. We are keeping this US trade mission incredibly busy up beforehand, but these market intelligence briefing workshops are all about that essential knowledge that is required before you set up business and start expanding in the US. So thank you everyone for your participation. I won't record this afterwards. It has already been recorded, but I'll be posting to YouTube and posting to Slack. Yehuda, if there are any further questions, and to Chris, how can the cohort contact you?
I'll post our contact details up. Yeah, absolutely. I'll post our contact details up onto Slack, and unless there's an easier way.
Oh, there we go. Chris has put his email in the chat. Thank you so much for your time and effort and helping our company set up for success in the US.